Comes Jeff.
Good afternoon, everyone.
Hi, Christina.
Okay, we are live and we have enough to get started whenever everybody wants to get going.
Good afternoon, everyone. Today is May 18th. I would like to call the investment meeting to order at 4:34. Sue, could you do a roll call, please?
Angela Banks. Christina Bennett.
Present.
Lewis Cross. Sheila Goodwin.
Present.
Shanice Johnson.
Present.
Donna Jones. Yvette Levy. And Martell Mann isn't able to join us. Bobby Richardson.
Present.
Albert Sanders. Doris Walker.
Here.
Angela Banks.
She is joining us. She's on mute.
And Albert Sanders. Like he's joining.
Andrew, Albert, she just called roll call. She just called your name. Can you indicate that you're present?
He's on mute.
Yeah. Albert, can you indicate that you're present for today's meeting?
I guess you're talking to me.
Yes.
Present. My mute was on. I was like, what's going on? Not mute, like I couldn't, the volume mute was on the thing. I was like, everybody just smiling at me. Present.
Okay, and then Angie, are you there?
Oh, there she, oh, she's present. She raised her hand.
Okay, she raised her hand. Okay, very good. So we do have 7, so we do have a quorum.
Thanks, everyone. On today's agenda, we have ANCO that's going to be reviewing the quarterly performance report, the review of the manager structure, and a proposal of rebalancing recommendations along with preliminary review of April 2023 figures. Gwelda and Jeff, the floor is yours.
I will start off. If you bring up the quarterly reports, we'll start with that and then go into the rest of it.
Okay.
Okay, just a little bit of background on what was going on in the economy and the markets to frame the mindset for this particular report. So if you'll turn to page number, the next page. Can you hear me?
Yep.
Okay, so a little bit on the economy.
Hold on, Gwelda. Albert, can you put yourself on mute?
GDP continued to weaken in the first quarter of the year. The Fed raised interest rates, as you all know, a couple times, but we're hoping this is going to be the last raise. This raising of rates is being used to stem inflation. Raising of rates is not only domestic, but also international. The central banks have also doing the same thing to fight inflation. Interestingly enough, though, even with that, unemployment is still very low. Last report at 3.5%. As you know, banking stocks came under pressure. There were some failures in the first quarter of the year. We saw another takeover bank in the first quarter. U.S. and international stocks, though, were positive in the first quarter of 2023, and fixed income was also positive. You can move to the next page. So, as you can see here in the upper part of this page, represents the stock markets in the first quarter of the year. As you can see, everything is positive here. Large cap stocks, domestic stocks did really well. As you can see here, the S&P 500 delivered a return, nice positive return of 7.5%. The Russell 1000, also representing large cap stocks, had a very nice return of 7.5%. Small stocks represented by the Russell 2000, albeit positive, had the lowest return with 2.7%. If you look a little bit down the page, you'll see in the middle of the page, the MSCI EAFE representing the developed markets international. As you can see, it was the best performance in the first quarter, and a lot of it had to do with the weakening of the dollar. So the return on that was very good, with the EAFE returning 8.5%. A little bit below that, you see the bond markets. The Bloomberg aggregate is the broad U.S. bond market, and as you can see, the returns were positive in the first quarter of the year with a 3% return. The ag, but the investment grade corporate had the best return at 3.5%. What's not shown here is the high yield. High yield is also, I think, about 3.6, but similar returns. So everything was positive. This is a big difference from what we saw from returns of 2022. As you remember, 2022 was a very difficult year. And you look down below on this page and you can see the exact opposite of what we see up top. Everything is to the left of the solid line, which means that everything was negative with exception of the T-bill, which is at the bottom of the page with a positive return. So first quarter, we started to rebound somewhat in the markets, both fixed income as well as equities. You move forward, Sue, to page 7, 8. I think go back one, I'm sorry. This is the international market. This is the sector returns. As you can see here, the blue lines representing the segments that did well. Consumer services did extremely well. Info technology did really well, as you can see here in the first quarter of the year, and consumer discretionary did very well. It's very, very unlimited as far as sector performance in the first quarter of the year in the large cap area. Down below, you see small cap stocks, and you see the areas that did well: consumer discretionary, info tech, very similar to what you see for the other segments in large cap stocks. Move forward, Sue. One more page. Okay. As I already mentioned, kind of what was going on in the international market, so we won't belabor that. You can go forward. Okay, this is the bond markets. I mentioned the bond markets. You see here the quarter performance. U.S. Treasuries had a good return at 3%. As I mentioned high yield and U.S. corporates. You can see they're very similar. So nice positive returns there. As you can see here, the areas of the bond market that had the strongest performance were BAA, which is a little bit lower in credit structure than the AAA bonds. And as you can see here at the bottom, as I mentioned, negative returns last year, so a complete reversal in both stocks and bonds in the first quarter of the year. Can move forward. Keep going. And if there are no questions on what happened in the economy, we can go straight to the actual performance of the fund. So here on this page, you notice this is where we look at the asset allocation of the plan.
Before you get too far gone, can you go back to page 4? I need to ask you something.
Sure. Right here?
Yeah, it's about the Russell.
Yes.
It stated here that Russell was the weakest performer for the year. It declined 11.
That's the Russell 2000. Russell
Yes.
2000 at the bottom. You see the lower chart.
Yeah.
That's the 1 year return. Russell 2000.
Right, and then the next
cap.
year, the next year you have it that it went up to 14.4%. So to round that off for the year, they only went up 3% or 4%.
Wait a minute. At the bottom, you've got the one year period ending March 31st,
Uh-huh.
Okay.
which means that it was down 11.6%.
Right.
Up at the top, the Russell 2000, the same index is for the
Mhm.
quarter, just for the first quarter was up 2.7%.
Yeah.
You see what I'm saying? Does that make sense?
Yeah, I just needed some clarification on that.
Yeah, the bottom chart is the 1-year number. The top
Mhm.
chart is just the 3-month return.
Okay.
Okay? Does
Mhm.
that clear it up?
Yeah.
Okay, all right. So if you'll go to the asset allocation page, which is page 12, I think it's page 12. There it is. Okay, there we are. Okay, as you'll remember, the gray bars represent the minimum and maximum for each of the segments. And as you can see here, everything is within the range that has been established. The dark vertical line in each of those bars represents the target. If you look on here, you'll see that the area that are most out of balance is core fixed income is furthest off the target, and private debt, which we've started addressing. So some of those things will go back into balance once we start allocating the returns. Allocating the assets. But for as far as policy is concerned, everything's in balance. Go to the next page. Here you show the market value increase, thank goodness, from the end of the year last year. You had a market value of 807,339,157. As you can see, we have an increase here in market value to 818,157,974. So we're starting to get back some of what was lost in 2022. Okay, Sue, you can skip over the next couple of pages and go directly to the brokerage. Okay, this is a brokerage. As you know, Intech, you don't need to think about that one because Intech is no longer with the fund. That's just a little bit of residual that was left over in the what was left of their holdings. As you can see here, amongst the large cap managers and the domestic small mid cap managers, the one manager that's slightly below their target is Systematic at 21%. But this is just the first quarter of the year, so we will continue to watch them for the rest of the year. We haven't had problems with them in the past, so I think that number will improve over time, so not to worry about them. The other managers on here are fine with the exception of Earnest Partners. We checked, I don't believe they did any trading. We're still making sure about that, but typically they have not had a problem in the past meeting their commission requirements, but this particular quarter they did not report anything, and Jeff has reached out to them to verify that is in fact correct. But we will be looking forward, and if we get an update, we'll let you all know at the next meeting. So, but in general, all your managers are complying with the commission goal for each of the different parts of the market. Next page, Sue, should be the reconciliation. As you can see here on the, and let's go to the next page that has the totals in it. Okay, you can see as you start out here in that first column, market value column, you can see you started out with 807,339,157 at the beginning of March. You had contributions of $8.7 million, distributions out of $26.3 million, management fees of $98,296, other expenses of $12,484, and a capital gain of $28,565,452 to end the quarter at $818,157,974. So that's your financial reconciliation for the quarter ending March 31st. Are there any questions on that background information before we move to the actual fund, which is going to be page 24, I believe, Stu? No, go one more page. I'm sorry. No, one more. My page numbering. There we go. Okay. As you can see here, the fund actually was slightly below the policy index, the return of 3.61 versus 4.3 for the policy, which did not rank well. Most of that underperformance came, you'll see below in the large cap segment of the fund. So you see there right below that area, you see domestic equity was a return of 4.01 versus the Russell 3000 represents both large cap and small cap stocks. As you can see here, the return in domestic equity is 4% versus 7.18 for the Russell 3000. Before I go any further into this, let me just make a couple comments on the total fund. The total fund, we actually in the, albeit a negative return on a relative basis for the 1 year, you see the fund is 17th and was protected on the downside with a negative 3.62 versus a negative 4.93 for a static index. 3-year returns, you're starting to see the ranking better, as well as the fund has exceeded the policy index in the 3-year time period at 11.0 versus 10.2. So we're starting to see the rankings improve. And that was one thing that Jeff and I talked about when we first brought on the account, that we were trying to make sure we started to see some improvement in the rankings versus other public funds of similar size. The one comment I will make is since inception, return is 6.65, which is below what your actuary is stating at 7.55. So we're still trying to work towards getting the long-term returns up to what the actuary has stated that you need in order to make sure you meet all the benefit payments until the last person is within the fund. So as I mentioned, drilling down the page and you look on here, the weakness came in domestic equity. As you can see here, underperformance and slightly below median for the quarter versus other domestic equity managers. If you go down further and drill a little further, you'll see, go down to the active portion of the fund, which starts with Edgar Lomax. As you can see, Edgar Lomax returned negatively this quarter. If you remember back in the first part of the page, large cap growth was one of the better segments. Value was one on the lower, did not perform as well as growth. There was a reversal from last year. So here you'll see Edgar Lomax, a return was a negative 2.9, and they ranked poorly in their universe. Last year was a time for value. As you can see, they're protected on the downside. And the 1-year number with a negative 4.34 versus a negative 5.91. So they are a high quality, traditional, very deep value manager. You wouldn't expect them to perform well in this type of market. The managers in the value index, or the stocks in the value index that actually did better were those that had a little bit growthier style to them, even though they're value managers. Value stocks, they had those are the stocks that actually did best in this market. Now, if you go over to the next page, we've got the growth, large cap growth. As you can see here, the index, this has been difficult for a lot of managers. You see the large cap growth composite return was 13.5. And you've got a stock index there, which we just got invested in February, so you don't have a full quarter of returns. But the TCW is your large cap growth manager, 13.89, but not as good as the Russell 1000 growth at 14.37. Albeit they did not beat the index, they ranked well in the universe at 36 versus other large cap growth managers. This portion of the market has been a difficult market or index for active managers to beat. And a lot of that has to do with the high concentration in certain segments of the Russell 1000 growth. For instance, at the end of April, the index had 41% in technology, information technology. And that goes against what a lot of the managers are allowed to do as far as from a risk control standpoint, being that heavily concentrated in one particular segment. So you will see, not just here, but I've seen it across the board, a lot of large cap growth managers are having a very difficult time beating that growth index because of that heavy concentration. If you go down a little bit further, you're looking at your small to mid cap managers. Actually, you see the number here is pretty strong for that sector, 4.25 versus 2.74 for the index Russell 2000, and that rank is 43rd. If you look down below that, you will see Westfield, Systematic, and DFA all did very well versus their respective indices and all ranked at median or above. So small, micro, mid did well in the first quarter of the year. Next down is the total developed international. Remember, I said that international is one of the best performing areas. And as you can see here, this segment did really well, 11.9% with a rank of 9th in the first quarter of the year. Fidelity, not as strong versus their custom benchmark, but still a return of 8.8 versus their custom benchmark 11.9. What was the real winner is on the next page. You'll see that Causeway International Value Manager returned 14.6, more than double their custom benchmark, which was 5.9. And as you can see, it ranked second. So International contributed nicely to the total equity portion of the fund in the first quarter of the year. The next page is your emerging market segment of the fund, and you see the return here is 7.42% with a rank of 14th. And if you look down below that, you'll see that DFA was just slightly off at 3.9 versus basically 4% for the MSCI emerging markets. Invesco did very well this quarter, with them having a little bit more of a growth bias, with a return of 11.4 versus basically 4% for an MSCI emerging markets index, and ranking second. So the bulk of that return is a result of Invesco. In your managers exponents, as you can see here, slightly off this quarter, with a return of 5.23 versus 7.73 for MSCI World. If you look down the subcomponents of that manager, the one manager that did really well was Arga, but the other ones were not enough to make the composite return exceed the MSCI World index. Any questions on international or domestic markets before we move on to fixed income? Okay, if not, we'll go to the next page, Sue. As you can see here, the total fixed segment, which is inclusive of the subcomponents down of core as well as opportunistic, return was 3.15% versus the custom benchmark at 3%. If you drill down, you'll see that domestic fixed income actually did well here, with the core managers both performing well. Both Manulife and Ernest Partners deliver returns in excess of the Bloomberg aggregate, 3.4 for Manulife and 3.9 for Ernest Partners versus the index at 2.96. And this also gave them both nice rankings in their peer group, Manulife at 17th and Ernest Partners in the first quartile at 3rd. Opportunistic fixed income is beneath that, and you can see they're just slightly below the Bloomberg Global Multiverse, and you'll see 2.95, or basically 3% versus 3%, pretty much almost flat, just slightly off. If you look at the subcomponents here, the managers that actually outperform their respective benchmarks is Neuberger, Berman, opportunistic fixed at 3.6 versus 3.3%. The Lazard emerging markets debt 2.74 at 1.87, and the Exponents opportunistic portfolio 3.8 at 2.96. So the fixed income components have actually delivered good results. We're seeing more positive this time. We didn't have it like last time. It was a bunch of negatives. Next page is your global. You see your global asset allocation, and your PIMCO all asset is the one manager you have there at 3.43, below their custom benchmark at 5.84. If you look at the long-term numbers, though, for the PIMCO all asset, this particular fund has delivered, with the exception of the one-year number, has delivered and exceeded their custom benchmark in all time periods measured. And then the next section is your hedge fund segment, also positive, 2.1 versus the index at 0.7. If you look at the subcomponents, what really delivered the returns was the white box and the white box portfolio at 2.25, and Grosvenor also did well at 1.8. and they both beat their respective benchmarks. Both of these managers, if you look at them since inception, have delivered good returns versus their respective indices long-term. White Box being with you since 2014 and Grosvenor since 2016. And then the last part of the fund that we will talk about here, and we'll go back to private equity in the back, is your real estate. As you know, we've already put the U.S. Trumbull Property Fund on redemption. We're in redemption queue. As you can see here, we expected this. Real estate has taken a bit of a hit, especially in values, and over the last year. So, as you can see here, the Trumbull Fund was a negative 7.2 versus the NCREIF Odyssey at a negative 3.4. The Trumbull Property Income Fund did protect on the downside, a negative 2.2 versus negative 3.38. But we were expecting this correction or reversal, and what we have seen is a very positive area, real estate over time. Any questions on any of the segments before we move to the watch list? No? Okay. Okay, to the back of the report, Sue, I believe it's page 83, but I'm not sure what it is on the. Okay, on this page, the only change on this page as far as watch is concerned in your watch list is based on a 2-year rolling period versus the index, as well as in the peer group. The only change from the last time is you now have exponents on the emerging managers. They're 2-year rolling, and for both the versus their custom index and their peer group. They failed in both of those, so they are now on watch for your policy. And then the other thing is your Loomis sales was on watch per the policy. Now they have not met the 2-year return versus the index, but they're above the median on the 2-year rolling for peer group. So as a result, they don't qualify for watch anymore. Those are your 2 changes. And then the next section, I want to just make a couple comments on. The next part is your privates portfolio. On here, you will there's the private equity composite, the private debt, and the real estate composite for the private pieces. As you can see here, all segments have delivered good returns. The private equity composite, where it says IRR, is your internal rate of return collectively over time. You've done well at 10.8% for that segment. Private debt is right below that in the next section, a 10.8 IRR. And the real estate composite, owing mostly to Elmtree, which you've had for a couple years now, an internal rate of return of 16.7%. So the private portion of your funds, albeit a lot of it is very, very new, you've gotten some nice returns from your private managers in all 3 different segments. Are there any questions on the performance report before I turn things over to Jeff?
Gwilda,
Yes.
so I'm looking at some of these, and I think it's probably because the capital deployed is just so small, right? And so I'm just gonna talk about the big negatives here. So we approved in December of 2021 Asia Alternatives, Harbor Vest, I think Fairview, and who was the other one?
Fairview was just approved in
the first quarter of 2022.
Yeah,
right.
So,
but I'm looking at these negatives, right? So the negative 17.9 was Cray-Hill, and I can't remember, they were 21. So Fairview was 2022, and then you go down, Adelaide was 2021. So I just wanted everybody to know that while we see negatives, it's because the capital deployed
right.
hasn't had time to work.
Right.
Right. So if you give me $100 and I don't invest it quite yet, or it's just in its inception, then it's going to take time for that $100 that we invested to be put to use and then be able to track a return. So I just wanted to address that for some trustees. While HarborFest may have been further along in their fundraising, if they called capital, and that's why they're positive potentially, is because they're in the same boat as in 2021. They had $1.7 million drawdown, but depending on where they were in their funding, and I think we caught them on the tail end of their fundraising, is that they had the ability to deploy that capital and put it in quickly, as opposed to having to find an investment. And so I just wanted to bring that to the table. So as trustees look at these type of things, that they're able to understand why they're negative, not because we've lost money, but because the capital hasn't had time to deploy.
Right. And that is what you'll hear sometimes. And we'll actually have a bit of education on private equity later in the year when we come in with a private equity recommendation. That is what they call the J-curve effect. And that's not unusual for you to see a negative return the first few years you have something. And then as Christina stated, as they buy and the components within or companies within their portfolios start to show positives, then you'll see the numbers start to go positive. But it's not unusual to see negative numbers initially in your private investments.
Mm-hmm.
Okay. If there are no questions, I will turn it over to Jeff. He's going to go through the flash report and make some comments on manager structure, and also the discussion we had with to raise money for benefit payments and expenses for the rest of the year.
Great, thanks. Sue, if you want to pull up the April report. And if we flip over to the first page, and I'll just make a couple of comments on this. So these are a couple of the metrics that we show for market indices, and as well as some style and some other benchmarks and fixed income. But I guess a couple of key things to look at here. If you look at that top section on the left of the equities, you see really a continuation of the trend that we saw in the past quarter, with the exception of the negative returns on mid and small cap and emerging. But I think more of a continuation of those areas of the market, mid cap, small cap, emerging markets, which the whole market views as to be riskier than large cap stocks or fixed income or things, have trailed. And that's not surprising where we sit in the markets right now in the economy. It's when you have sort of a mixed bag of things, where the world is kind of nervous about a few things, like a debt ceiling and what ultimately is going to happen with inflation, but also the tug of war with, we still see some really good things in the economy, like the employment numbers. And today we saw a handful of things as far as good news on retail sales. So it's people are out there spending money. So when you have sort of that back and forth, everyone says, well, we like the equity markets, but we want to be a little bit safer in the equity markets. And so that's when you see things like large cap stocks doing better. And in outside of the US, so those two lines at the bottom of that chart, there's the EFA, which are the developed markets, which again, if you just think of international stocks by themselves, the world views developed markets to be a little safer than the emerging markets. And so those are the two bottom lines, and the things that are viewed as a little safer had a really good return at 2.8%, in the emerging markets, that negative return. So again, just a bit of that trend. So if you go to that set of boxes, the colorful boxes to the right, again, just to think about trends and some of the things that Gwelda talked about that have been an issue, or where we saw growth stocks having some issues last year, and sort of that benchmark effect, and Apple and Microsoft, whatever they do, that's sort of what that large cap growth index does. And And we saw how that was a lot worse than value last year, although both are negative, and you can see those numbers in the boxes to the right. But now a big difference to what we've seen so far for this year. So if you look at growth stocks, now a pretty big return, positive 15.5, and I'm talking about large cap growth. That's all the way at the top. So again, how those boxes work, we have value on the left, growth on the right, sort of a blend right in the middle, and then the capitalizations, the large cap, mid and small as we go down the boxes. So you see a big difference. Value is still positive, but well behind growth. And so again, these are things to sort of think about as we take a look at what the managers did for the past month. And again, just to put a cap on some of the things that Gwelda talked about in the quarterly report, but you see the one that sort of does stand out the most for this year is that bottom left box, and that's small cap value. So again, think about what I previously said. Everyone's sort of looking at small caps as being having more perceived risk, and so the market has avoided those. But also throw into that bucket now, recall at the last meeting, we talked about Silicon Valley Bank and all of these regional bank problems. Well, a lot of those that are publicly traded fall into a couple of those buckets there, primarily that mid cap value and that small cap value. Both of those boxes have a lot of those banks within that category. So again, when you continue to see some of the stress on these banks, and another story coming out about a potential bank failure, well, everybody's selling those stocks. So that's just another issue that's created some pressure there. And again, we'll see that as we take a look at the past month for what our mid and small cap managers did in the plan. So certainly they're not immune to some of these pressures that we saw. So fixed income, if you just jump down to that bottom left chart, or sorry, bottom left table that has the key rates. Again, just think of how far we've come, not only from the beginning of this year, where we started that 3-month or that short-term rate at about 4.3%, to now over 5%, but just now jump back a year prior to that, where we were at 0. So again, that's sort of the interest rate headwind that the world has faced up until now, but it also creates a couple of sighs of relief for where we sit right now. So number one, with the Fed coming in and saying it's very possible at the next meeting that they take a pause, and we might not see another increase, at least for the next meeting, but I guess all bets are off as we look at the next couple of meetings. But just to digest again some of the economic data, because we are starting to see from an inflation standpoint, those numbers are coming in. So we're still off, we're still in that 5% range, but we want to be at 2. So we're much higher than where we want to be on annualized inflation, but we're moving in the right direction. So, and again, a couple things to think about on that point. If you look at that chart right next, or sorry, the table right next to it, which has all of the different commodities in there. And again, just seeing where a few things are between now, as of the end of April, and where we were when we began the year. So oil prices, which were right around $80. So those are down. That's always a big component of inflation, watching where those oil prices are. And then all the way down at the bottom, those are aggregate commodity prices. So that includes a bunch of different commodities, the corn, copper, some of the metals, things we see here. But more of an aggregate look. And again, in general, those prices have come in. So again, that just it starts to show that we have a trend from inflation that's moved in the right direction. And again, having a Fed coming in and solidifying that and saying we think our interest rate policy has been doing a good job. And I hate to use the term Goldilocks, because we hear it all the time for the situation where the Fed's able to combat inflation, but not totally derail the economy. So we're kind of there, but we're still not out of the woods yet. So we are moving in the right direction. And again, the markets have recognized that. So we certainly saw that in the first quarter, and then this last month of April was the same. May has been a bit of a mixed bag. So it's again, a lot of what we've seen in May as far as the volatility in the markets has revolved around the day-to-day talks on the debt ceiling. And so we sort of started the month off of saying, well, we don't think we're going to get anywhere with the talks, and it's very possible we could possibly see a default, and the government stops paying its bills, to where we are today of everybody, whether they're a Democrat or a Republican, getting on the right page and saying, no, that's not going to happen. We will come to some sort of an agreement, whether it's some spending cuts, raising the ceiling a little bit, but we're going to do what we have to do to not have a default, because that's bad. So certainly we've seen government shutdowns before, and that's again, not out of the realm of possibilities when you have these types of debt ceiling discussions. But again, those tend to not roil the markets and make people as nervous as an actual default, because that has big ramifications. That now ratings agencies have to come in and downgrade our debt. And so where we've seen interest rates going up from the Fed making rates go up, now we see interest rates go up even more, just due to the fact that everyone saw our debt get downgraded. So China, Japan, all of the big holders outside of the US, and certainly anybody inside the US that holds the debt, says, hey, we're risky, now we want to get paid for it. So interest rates keep going up even more. So that's and even besides what it just does to bonds in general, it really does create a lot of nervousness in the economy, not only here in the US, but on a global basis. So I think our government realizes that, and I think they're certainly going to work hard. And our understanding is by the end of the week, they should have some sort of agreement on what they're going to do with the debt ceiling. Was there a question?
No, it's just, I was just looking at the key rates.
Yes.
And if you look at 430, short-term interest rates were at 5%, but look at where we were in 2020, December. Right. We were even a year ago to 12/31/21. My computer's about to die. We were at 3 basis points, and now we're at 5 basis points. And right. When rates go up, bonds go down. So it's unfortunately we can't have our cake and eat it too.
Right, but I guess the good news on that being that now that if we have sort of leveled off at that point, that's now the going rate. So any company that now issues debt has to do it at 5%, and that's sort of the rate that everybody has to get paid at now. So we now have at least a larger coupon cushion for any debt that gets issued now, and that's a positive. So that's kind of our coupon return. And then again, I have CNBC on all day and hearing people go back and forth about, hey, we might even be in a position where the Fed has to lower interest rates this year. Some people say yes. A lot of people are still saying no, that won't happen this year. But the good news on that is just having that cushion or availability to do that. So if you go back, Christina, to 12/31 or of 21 or of 20, where we were at near zero rates, if we did have a major issue in the economy where the Fed needed to stimulate, they didn't have the ability to do it. I mean, at least by lowering interest rates. So you can certainly go out and do more of the quantitative easing, or what we all kind of call creating money, or things that sort of do that. But we don't have that interest rate tool available. That we do have now. So certainly when you sit at 5% rates, we have that ability now to, if we need a quarter point cut to help stimulate things, if the economy does stall out, it's there. And so again, I think the market recognizes that. And so on a go forward basis, I think there's all sorts of things to be optimistic about, at least on fixed income. So you think about this asset class from the overall diversification, and recall several months back when we did an asset allocation study and took a look at things and said, well, we're still going to see much better returns from equity versus fixed income, but the fixed income returns still being close to zero or not all that good. They weren't big contributors to an asset allocation scheme, and in contributing to that long-term return assumption. Well, if you start to plug in the new assumptions that we have on a go-forward basis for the next 10, 15, 20 years, fixed income will be a much more meaningful contributor to a total portfolio return, as should equities, because of some of the weakness that we saw last year. So valuations being attractive. So if you just start to plug things on that go-forward basis, we do look pretty good relative to that overall probability of meeting or exceeding that actual return assumption.
Well, and I just want everybody, and I can't remember if it was Doris or Bobby, but you guys came on at the end of 12/31/21, right? And so I remember the first report that you guys had to report on. I'm not sure if it was Bobby or Doris were like, wait a minute, let me just be really clear. Everything is red on our on our report. And so I look at, and I'm glad that Bobby and Doris are looking at these numbers and showing that, the market has moved and we do see positive returns. And while we are facing, debt ceiling issues, we are in a much better position than we were, a little over a year ago. So I just wanted to just kind of bring that full circle, and I appreciate the format that you presented, because it really does help our trustees a little bit more. So I appreciate it.
Great. Well, good. So, Sue, why don't we flip forward one page? And again, this is the asset allocation range chart. It won't look a whole lot different from what Gwilda showed, other than, again, when we have a good month in the markets like we did in certain areas, it's going to start to move some of those triangles to the right for us, which is good. But another thing that I did want to focus on here, because this is going to tie into what we talk about on rebalancing. So again, our goal is to maintain these long-term targets, and that is for a reason. If, again, going back to our asset allocation study and our previous portfolio structure study and how we came up with some of these targets, the objective is allocate towards things that and have long-term targets towards asset classes that we think give us the best return long-term, but then also have diversifiers. So fixed income, we don't expect longer-term makes as much money as equity, but there's a reason it's in the portfolio, because in normal markets, and I don't count last year as a normal market because you saw everything other than real estate was down, but in normal markets, we would expect a good amount of diversification from fixed income and these other areas of the market, the global balanced funds and private equity and debt. So again, all of these asset classes have a specific role in the portfolio, but the overriding goal is we want to meet or exceed the actuarial return assumption by the asset class structure that we have. We want to make sure we're diversified, so we're minimizing the amount of risk. And again, that's something we did with the portfolio structure study last year, was to say, where do we think we have excess risk? Do we have too much in small cap stocks? Do we have too much in emerging market stocks? What's the right place that we want to be? And so that's really what we addressed. And that's, so all of these vertical black lines, those are those targets we came up with. And so long term, we always want to be trying to stay towards those and not fall outside of the ranges, and have a systematic rebalancing process, which we're going to talk about in a moment. But again, I want to use this chart to say there is a method to our madness of how we reallocate, because we really want to stay on check with all of these targets. Because when you don't appropriately rebalance, so if we start to get too heavy in equity or any one of these asset classes relative to policy, and then you have a bad period, well, you pay the price. And alternatively, if you start to get too low in a certain asset class and don't rebalance, and then there is a rebound in that particular asset class, well, then you sort of miss it. So that's why we really want to try and stay on target and have these long-term allocations. And again, it'll make a little bit more sense when I talk about the rebalancing chart, because you might take a look at our rebalancing and say, hey, that was a really good manager and they've had great returns. Why are we taking several $1 million from them? And again, that's just part of the process. And I guess it's an unfortunate part of the process that to rebalance appropriately, you you sell winners and then you top up, and I hate to say the word losers, but you top up your lagging asset classes. And that's just an appropriate way to balance it. Long term, it does add value for a pension plan. Okay, why don't we jump forward one page, Sue? I'll try to get through this a little quicker, but you can see for the month, top line, that's the total system return at about positive 0.7%. So a nice, good, solid return to tack on a good quarter that we had, not too far off the policy index. So the items for both the month and the year-to-date period. And again, Gwilda talked a bit about these, but certainly it's going to be in the equity category and a couple places in particular. So you see the Lomax return below for the month and for the fiscal year period. And again, think about what we talked about on the value versus growth spectrum and think about, again, Lomax is going to be a bit more deep value. So the more you go down that value spectrum, the more they're going to trail an index relative to things that are at the, let's say, higher valuation or things that sort of straddle value and growth within that category. So being very deep value is something that's gone against them. But again, from how we have that position in the portfolio and overall sizing, it's something that we do think about. So is it going to be something that is diversified relative to other positions we have in the portfolio? And is it a good offset for the growth that we have in the portfolio? So if you scroll down a little bit, Sue, and again, not that 1 month or one quarter makes up an entire experience for a manager, but you see TCW where they didn't have the best year last year. Again, from some of the items that Gwilda had talked about in the index and the Microsoft effect and the Apple effect, but starting to get it back a little bit. So for the year-to-date period, we're pretty much in line with the benchmark and had a little value added for the month. So again, we'll certainly want to keep an eye on TCW and their positioning and how they look in the structure. And again, certainly also keeping an eye on them from their MWDBE brokerage standpoint to make sure that they're continuing to follow guidelines there as well. So, but again, a more favorable market for the growth stocks you see in general for the year-to-date period. For the active managers, 15% for a TCW versus a negative return for Lomax. So kind of flip-flop from what we saw over the past year. But again, this is why we tried to levelize those allocations and in style biases within the portfolio, so they will offset each other appropriately. And we really want to have a construct here that looks like the entire market. So we want to have representation that across different capitalization spectrums, because again, going back to my original discussion on right now, people don't like small cap stocks as much. They like large cap more. So having the ability to participate there, but we will have a reversal there. We're going to see markets where the mid and small cap stocks do better, and we have good representation. So flip forward one page, Sue.
Jeff, before you go on this one.
Sure.
So do you believe that large cap value may be out of favor over large cap growth in the going forward?
I think right now what probably the biggest issue for value, again, it continues to be the banks. I think once we start to see that levelize, number one, and number two, just interest rates, value stocks tend to be a lot more interest rate sensitive as well relative to growth stocks. And that's not just banks, because the banks get valued via interest rates, but the majority of a value universe, and in particular the large cap value universe, are also dividend paying stocks. The way the world values those is a little bit different, and they use a discount using a current interest rate. So again, think of it kind of almost like bonds as an inverse relationship, that when interest rates are going up, that can put a little bit of pressure on dividend paying stocks. So I think we've seen that kind of pressure, but now that we're starting to level out, hopefully, on the Fed raising rates, that we will see a rotation back to large cap. And again, I think from a valuation standpoint, the value stocks are a lot more attractive relative to growth at this point. But I think we at least start to see more of a leveling, and not the major deviations that we've seen over the past couple of years, where growth has outperformed by such a huge amount and then value outperforms by a huge amount. I think we at least start to see that swing more in the middle, where those deviations aren't as big. So I guess to answer your question, I think we should see more of a snapback from the value stocks, and then probably another tapering off of the growth stocks. Okay, so if you want to jump forward to the small and mid cap stocks. So again, tougher quarter for those managers. So in aggregate down about 2%. And you see on the micro cap side of the equation, and again, think of that spectrum of the smaller you go all the way down to micro cap. That's where the market thinks these are the riskiest. And so that's really going to be the impact from DFA, and also throw in sort of the double whammy for a DFA being a little bit more on the smaller end of small cap, but also having a value tilt. So again, think back to those boxes we saw a few pages earlier, where that bottom left box, which was small cap value, was the only thing that's been negative this year. So that's the category that this manager resides in. So again, from the standpoint of how we've positioned these are positioned at around 3 and 4% levels in the portfolio, because we know they can be a lot more volatile. And so that's to minimize downside risk, but we also have them at a size that we know they participate very well when we have those upside moves. So on the international side of the equation, a very strong month, 3.5%, and the managers in general were ahead of the benchmark on the developed side. And really good news too is right below that for emerging markets, as you saw, that was not a great asset class. So as you can see by the benchmark below, that the total market was down 1%, but you had 2 active managers that were pretty solidly positive. So adding a significant amount of value over an index that was actually down. So you really had a nice, what I'd call a bonus quarter from that segment of the portfolio. Flip forward one more page, Sue. Okay, so Exponents had on the global equity basis had a good month. You can see they're trailing somewhat still for the fiscal year period, just shy of 7% relative to a benchmark that's close to 9%. And you can see on a manager basis where the contributions and underperformance is coming from. So the Arga portfolio being the strongest with a double-digit return. And then you can see Redwood about 8%, not too far off of their benchmark, and Martin almost in line with theirs, but Foresight really being having the biggest issue for the year. So again, if you recall a couple quarters back where we looked at the structure and certainly how Exponents has tried to build this portfolio of having things that are really do not have a lot of overlap and act very differently in different market environments. So again, when you see a differential like an Arga at 12% versus a Foresight at 1%, it is creating that diversification. So when we look at the total portfolio construct, again, for the fiscal year, we're off, but we're not off by a massive amount. And we're also talking about a shorter time period. And certainly from the standpoint of we haven't had this structure in the portfolio that long. It only goes back to September of 2020, so we don't have those longer periods. But we can say from the inception, it's been right in line with the benchmark. So again, from a construction standpoint and how they're diversified, we would expect as we go forward, number one, with some positive expectations for the international markets, that we're going to see some better returns here. And again, valuations. We know valuations outside of the U.S. have been depressed quite a bit. So that's why we expect some better returns from international. And there's also a currency effect. So as interest rates and currencies tend to line up quite a bit. So when interest rates level off and are going down, that means we might see the dollar be a little bit more depressed. The lower the value of the dollar, that's actually better for a U.S. investor that has money outside of the U.S. So again, one of those inverse relationships that we look at. So again, just some things to think about and to have some optimism on not only what Exponence is doing, but also your other international managers in the portfolio. Next page, Sue. Okay, fixed income managers. And again, a nice positive return for fixed income, not as frothy as we saw in some areas of the equity markets, but again, just that realization from the market that we're seeing this slowdown from the Fed and interest rates, and really a good amount of interest now coming back into the fixed income markets. So you can see for the month total fixed income managers at about 0.5%, but the nice number is that fiscal year to date number. So for a 4-month period being close to 4%. So again, relative to where we've been in the world of fixed income, that's a pretty good place to be. And again, if we are at the level where the Fed is starting to slow down, we're going to continue to see we should see some fairly good fixed income returns as we go through the rest of the year. So from a component standpoint, you see the core managers at about 0.6%, the opportunistic bucket in aggregate at about 0.5%. And again, most of those managers in that category sort of in line. Exponence down at the bottom there, their portfolio, good to see having a nice not only a month but also a good year-to-date period as well at almost 5.5%. So again, some of these things in their portfolio that were a little bit on that higher end, higher coupon, higher risk end of the spectrum, now starting to kick in this environment. So a nice return that we see there as well. And Sue, if you want to scroll down a little bit. Okay, that's it for that page. And then we'll go to the last page. And for the global asset allocation, the PIMCO portfolio, again, participating nicely from both a good equity and fixed income market. Recall that that portfolio can sort of go everywhere and do anything. So they can be in US equities, non-US equities, fixed income around the globe. They can sort of do it all and allocate their portfolio as they see is best fit for a go forward basis. So at about 0.8%, not far off of their benchmark, a little bit further behind on the fiscal year period and their 1 year period, but you see on a longer term basis still adding some value relative to their benchmark. And again, we look at this as something that just acts differently. Acts as a good diversifier to the other pieces of the portfolio, and sort of operates like the group right below it, the hedge funds, but they do it on a much more liquid basis. White Box, a nice solid month at 1.3% relative to their index average, which was slightly down, and then Grosvenor a little bit ahead of their benchmark. So again, the strategies that White Box and Grosvenor are in, a lot of those tend to be tied to interest rates. So when interest rates are lower, some of the hedge fund strategies that those managers are involved in are harder to get returns from. When we now go into an environment that has much higher interest rates, that helps them out. That helps out a number of their strategies, whether it's on the fixed income basis or whether they're doing things that are based on spreads. And a lot of these spreads that they invest in or try to take advantage of get priced on risk-free interest rates. So the higher that number goes, the better the opportunity set for the hedge fund managers. So again, an area of the market that we don't have set significantly high in the portfolio because we understand there's liquidity issues. They're not the most liquid. Some of them we can only get money out on a quarterly basis. And again, think about Entrust, where even when they had quarterly liquidity, we still have this piece of money that we can't get out. So again, those are all things we take into account when we look at the asset allocation, the structure, upside versus downside in liquidity. So that's what sort of gets us at our 5 to 6% target for this asset class. But again, long term has been a favorable contributor to the overall construct.
So let me see. Guelta, did I hear that we lost our relationship manager at Grosvenor? You're on mute.
I haven't heard that. I don't.
Eric Hall was our relationship manager.
Oh, I didn't know. I didn't know he was gone. I'm sorry. I did not know that. Interesting.
Can you find out who our new person is?
I will find out. I will definitely find out.
Maybe the birdie that told me may be wrong, but that's what I heard.
Okay, I'll find out. I'll make a call tomorrow.
Yeah, Eric's not someone that we, or I don't know, Grella, maybe you have, not someone I've dealt with here, but I've dealt with Sean Conroy here locally and some other folks. So
yeah. I know Eric, but I have not spoken with him with respect to this. I'm surprised I haven't heard. Okay, I'll find out.
Yeah, he was our manager on both, on some of these, especially the last one that we did on private equity. But he's been around for a while. He's
been around for a good while. I know Eric well. Okay, I'll find out.
Thank you.
Well, good. So if there's not any questions, the next page is just the private, so there's nothing really to report on a monthly basis for those. So I'll pause and see if anybody has any questions on the month.
On Elm Tree, did they pay out fully? I know, Gwilda, you had sent me something on an email, but
not yet.
Okay.
They're in the process. We've gotten a big chunk, but we're still waiting on 2 more tranches from their sale.
Yep. So that one should be a nice return for us.
Yep.
I know that they are in their fundraising mode again. So I don't know how much we've gotten back from them. I think the first allocation we did was 8 million or 10 million. The second allocation we did, I think, was 6, Sue.
I'm thinking it was 5 million.
5 or 6 million. So he's sent me a couple of text messages just saying, hey, can you, we've done an amazing job, double-digit growth from both funds. Your life is not 5 to 7 years, it's been more 0 to 3 years. So that is up to see if we are interested in revamping up on the next fund. But I don't know where that fits in with the pacing plan and so that is not my, I don't focus on these the way you and Jeff do, but I just want you to know I've got this constant bird in my ear, wanting us to revamp.
I'll reach out to him because, if you remember from the pacing study, you were somewhat over allocated to real estate, and we were waiting for the valuations to come in to determine. And if you go back to that asset allocation page, we're still over target. So we were going to address this and look at it again. In mid-year to determine if we're going to allocate anything to real estate in 2023. It may be 2024, so we may miss that fundraise. But I'll contact Elm Tree and let them know that right now we're not looking to allocate anything within the next few months. So not for this, and that's across the board with all of our clients. We're seeing real estate because of the denominator effect. In most of our clients, it is over allocated. We're over the target. So
I'm going to have to jump off, or it's my last couple of hours with my daughter tonight before I see her for a couple months. I know that you were going to talk about the
Rebound.
rebalancing. I reviewed it. I'm okay with it. I've had a discussion with Sue, and I know that Sue will share my thoughts and comments on it, but I support the allocation. Just wanted everyone to know on the call that Andrew did his allocations without informing us. He just would, move more towards a policy, take cash when he could. And we always had higher cash balances. Was that the right thing to do? Maybe not deploy the assets longer, leave them in the portfolios. Who knows? But I did talk to Sue and really like the fact that she's reaching out to both of you to ask for your advice, and knowing that the reallocation is it is a long-term play, not an immediate play. And I think it'll bode well for us, knowing that we have that guidance and that policy of her informing the board of where we're going to move some assets. So I'm going to have to jump off. Albert, if you can close out the meeting for me. I think you're still on. I can't see. And I'm totally for the rebalancing and the selections that we did. But I thank everyone for being on. I just have to go play Mama Bear for a couple more hours.
Okay, take care.
Thank you, Christina.
everyone. All right, take care. Bye-bye.
All right, Sue, if you want to throw up the rebalancing table, and well, Christina just did it, so I don't even, we don't need to go through this. Okay, I don't know if we can make it maybe a little smaller. So I know it looks like there's a lot of numbers here, but I wanted to at least put this together in a format that makes some sense. And again, I want to go back to the discussion that we had on the bars and the allocation charts. And so all of those the bars and the middle lines will all correspond to what you see on the way all the way to the right, which says policy percent. So these will all be the same numbers, and those are our targets. So that's where for each one of these asset classes in aggregate, and then each of the individual managers, all the way to the right where it says policy, that's the target. So the objective here is whenever we're rebalancing is to try and stay pretty close to all of those targets. And so sometimes that means things that aren't very pleasant. Sometimes it means taking money from decent managers. And I guess two good examples here are Causeway and Exponence. So you see that those are the largest amounts that we have coming out. And I guess at first glance you say, hey, those are really great managers. We hate to take money away. But if you look at the percentages, so if you look to that third column, so you have asset class, which is all the way to the left, which the asset classes and the managers. Then the one next to that, those were our asset values for each of the managers as of a couple days ago. And then the percentage, so that's what the actual percentages are. So what we look to do is compare those actual percentages to all the way to the right, the targets that we want to be at. So let's use Causeway as an example. So you see at Causeway is about $56.9 million as of 5/15, as of May 15. That represented 7% of the total portfolio. And then if you go all the way to the right, what's our target for that manager? Well, we're targeting 5.5%. So that would mean to get closer to that target, we would have to pull out around $15 million. So again, this doesn't always work perfectly. There's things that we tend to think about when we do this process too. One is, what's the liquidity source? Is it a manager that has more liquidity than another? How quickly can we get money for some of these? Like if it's a separately managed account or a mutual fund, we can tend to get money quicker than a commingled fund that might have, let's say, semi, inter-month liquidity or once a month liquidity. or all the way down at the bottom, the privates, which are, you know, some of the real estate funds, we can't get money right away. And then a lot of the private equity, private debt, we just don't have the ability at all to get any money from those. So again, we always try to take that into account when we first fund a private equity or private debt manager to make sure we're not going to get too far out of whack. And again, I don't want to get off course here and talk about pacing, but that's what our annual pacing study tries to account for as well, that we can always stay close to these targets that we need, and then be able to rebalance the rest of the portfolio elsewhere. So the other thing to think about too is that this is a sizable chunk of money that's coming out of the fund. So Sue, if you scroll all the way to the bottom, in that column in the exact middle where you see $64 million. So that's the total amount coming out. So there's currently $9 million in cash, and then Sue does an estimate of how much she will need for the rest of the year in addition to that. And so the additional amount to that 9 million is 55 million. So in total, that's how much that comes out. So now the trick to what we do here with rebalancing is we're not taking it all out at once, but we sort of have to estimate where we think we're going to be and to try and phase things as well. So if the markets do move up in one direction or move down and kind of zigzag for us, that we at least tend to stay pretty close throughout the year. So when you look at these figures, and we've talked to Sue about this, and we'll advise the trustees as well, that we would want to phase this in a certain manner. So how we would phase this is to say the things that we think are most overweight and have a decent amount of liquidity right now are the international equity managers. So that section, we're starting with Fidelity International Growth at 5 million, then Causeway, then DFA and Invesco. So as Sue needs the money, those would be the first places she will pull from. The second segment would be the U.S. equity managers. So Sue, if you want to scroll back up, sorry that we're kind of bouncing around here. So the Edgar Lomax, Westfield, and Systematic. So that would be sort of the next tranche that Sue would start pulling money from as the year goes by. And then Exponents on the global equity segment would be the final piece of the puzzle. And that's the one where we probably would see some variability. So number one, between whatever Sue sees coming in from contributions or what we need for benefit payments, and then also money that may come back from private equity, private debt managers, real estate managers, or we might have capital calls that have to go out. So Exponents might end up being the swing factor because if we leave them at the end. So very possible we get to a point and Sue says we don't need as much money, and so maybe that doesn't end up being as large as we're targeting. But that's sort of the methodology that we would recommend to rebalance here. Again, with the overall objective to make sure that we're staying pretty close to all of those targets on the right within the portfolio structure. So I'll pause there. Again, I know we're sort of staring at a bunch of different numbers. So if anybody has specific questions or would like us to walk through anything else here.
Hey, Jeff, this is Angie. I'm just wondering what the red highlighted numbers indicate.
That's a very good question. I think that's just something that I missed when I pulled in a number from, because these all get pulled in from an accounting spreadsheet. So I think it might just be something how our accounting group had it coded, but there's no, I don't know, Gweld, I don't think there's no rhyme or reason to that, is there? I think it's just from how our accounting group the numbers.
I just think that they shouldn't have been highlighted in red. They should be
so
black.
Apologies for that. We'll make sure that gets fixed next time we run through these. But good catch. But there is no there's no specific rationale for that. Other questions, comments? Okay, Sue, I don't know how you, how this generally operates. Do you want the board to, or the committee to approve this, or is it automatically approved because it's in the policy? I'm not sure how you'll operate that.
Yeah, I think it's fine if we want to do a motion. I don't have anything written, but I think if we want to do a motion, that just puts it in the record that, we're moving forward with this particular rebalancing plan.
Well, I'll move that we approve the proposed target asset allocation as presented.
I second that motion.
Excuse me. Are we voting on the allocations? Or are we voting to present it to the full board?
There should be a vote just to approve it out of committee, because I think it still has to be presented to the full board.
Yeah, that's correct. This would be the recommendation from the committee.
Okay.
And it's the rebalancing by using the target allocation, right? Are we, I should ask this before I second it. Isn't it the motion should be to accept the rebalancing plan by using the proposed target asset?
That's correct. That's correct.
Right.
So
Can you restate the motion so that we can be clear on exactly what we're saying here?
Okay, well, what do I have to do? Like take back the
I'll take back my second.
Okay, yeah, Angie, just redo it with the additional stuff, I think. Is that right, Sue?
Yeah,
Okay, so withdraw the motion and then restate it?
yes, you can restate the motion. Yeah.
Okay. Okay, Angie.
Well, I move that we accept the rebalancing plan per the proposed target asset allocation.
I second that, Ms. Banks.
Is it a plan or is it a recommendation?
Well, the committee is recommending to the full board this plan.
Okay, all right.
Okay, well, why don't we just state that that's what we're doing? Because you're just saying accepting the plan.
Okay, so do we need to restate it again, Angie, with that?
Yes, you do.
Okay.
Well, I'll just withdraw my motion and somebody else can make it.
Okay. Angie, can you give it one more go? I can't hear.
I'm not sure what we're doing, so
Yeah.
I think Sheila, maybe you can make the motion.
I make a motion that we recommend to the board this reallocation plan.
Recommendation plan.
Recommendation plan, yes.
You forgot to add balancing.
And balance and rebalance.
Rebalancing.
And rebalancing.
I second that motion.
Okay. Roll call.
Was there any further
Wait.
Oh,
Are you
discussion.
supposed to have a,
Discussion.
all right.
We have discussion. Is that what we're having now, Sue?
Yeah, we're having a discussion now.
Al, I'm sorry, Al.
Yes, any discussion? Hearing no discussion, do we need a roll call vote or can we just do a by hand since it's going to the board?
Yeah, it'd be a roll call vote.
Can I have a roll call vote, please, Susan?
Yes. Angela Banks,
Yes.
Louis Cross,
Yes.
Sheila Goodwin,
Yes, yes.
Shanice Johnson,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Doris Walker.
Yes.
All right, so we do have 7. The motion carries.
Okay.
All right, thank you all for voting that, so we can move on and make sure we got enough money to pay our peoples.
Al, you need a motion to adjourn or?
Hold on, slow down. I might have some other discussion
Oh, you
questions.
got some more? I'm sorry, sir. I'm sorry.
No, I don't have any more. Any other discussion, any other concerns or? And again, go ahead.
I was just gonna say there wasn't anything else on the agenda.
Okay.
Okay.
Well,
Thank you,
again,
Welda and Jeff.
Hey,
You
hold
all
on,
did a
dude. Hold
fantastic-
on, Chairman.
Yes, sir. I'm
You're not
sorry.
chairman of this committee.
Yes, sir. Yes, sir.
But thank ANCO as usual with Jeff and Welda for you taking care of us, and we appreciate all the work that you're doing and helping us understand exactly what's going on with our portfolio, so we can share things
Right.
with others, and we're getting more educated ourselves.
That's
We
right.
appreciate that.
You're quite welcome.
We appreciate everyone's time and certainly great questions. And we love that you're all digging in and grasping. So it's fantastic.
All right, another discussion. Can we get immersion? Can we get a motion to adjourn?
I'd like to make a motion to adjourn.
Thank you,
And I
Chairman.
second.
All in favor?
Aye.
Aye.
Any opposed? I'm doing Susan's job. Motion passes.
Okay. Good night,
Motion
everybody.
passes. Have a good evening. Have a good week, especially the people in the classroom. One more week to go.
Right.
Yeah. Congrats to everybody almost.
Yeah, exactly. Enjoy your vacations. Thank you. Take
Okay.
care.
Good night, everybody.
Right.
Good
Bye-bye.
night.
Right, good night.